Don't blame me. Whether it's risking a national default or driving banks to failure, it's got to be someone else's fault. This is Bloomberg Wall Street Week. I'm David Weston. This week, economist Glenn Hubbard on the damage being done by the fight over the federal deficit. Deborah Lair of Edelman Global Advisory on what China stands to gain from U.S. turmoil.
How do they build relations either with the United States to keep those markets open, or can they find new markets?
And Kathryn Judge of Columbia on whether we need all of those regional banks after all.
We're seeing very real questions about the regional bank business model.
This week, Global Wall Street was looking for someone to step up and take some responsibility, like for the failure of 3 major regional banks. And the former head of Silicon Valley Bank was there to help, as he found a host of culprits other than himself, like the Fed and social media.
I believe that SVB's failure was brought about by a series of unprecedented events.
But the chair of the Senate Banking Committee had a decidedly different view.
We know your banks were fatally mismanaged. The next obvious question is why? The simple answer, the same answer we find to most questions about big bank failures, because the executives were getting rich.
And when it comes to the debt ceiling, Republicans and Democrats picked up the theme of pointing fingers at everyone but themselves for the risk of the United States flirting with reneging on its debt for the first time in 234 years. As President Biden has put the onus on Republicans, and Speaker McCarthy continues to point his finger at President Biden.
Do we have obstacles? Yes, we have a big obstacle in the White House.
But even as the two sides blamed one another, they did find some room for optimism.
Confident that we'll get the agreement on the budget, that America will not default.
But despite all the disagreement and the urgency, President Biden thought things were going well enough that he could head over to the G7 meetings in Hiroshima, Japan at the end of the week, though he did promise to get back by Sunday.
The nature of the presidency is addressing many of the critical matters all at once, so I'm confident we're going to continue to make progress toward avoiding default. However, I'm cutting my trip short.
Then on Friday, Morgan Stanley CEO James Gorman surprised Wall Street by announcing to shareholders that he would be stepping down as CEO within the next 12 months, raising questions about how his yet-to-be-named successor may change the direction of a firm Gorman led so successfully.
He's built the firm through all kinds of acquisitions. He's been a brilliant acquirer. Much of it has been through acquisition. And so maybe now you translate from an acquisitive CEO to a managing CEO who puts all these disparate pieces together.
Markets on the whole did pretty well this week, and as the S&P 500 added another 1.65%, taking it to 4191, well above almost all of our Wall Street week elves, who actually moved the other way in their median call for the year end, taking it down to an even 4,000. The Nasdaq did even better than the S&P, up over 3% for the week, while the yield on the 10-year Treasury added 21 basis points, ending the week at 3.686. To take us through the week, we welcome now Alicia Levine, BNY Mellon Head of Investment Strategy and Equity Advisory Solutions, and Gerard Cassidy, RBC Capital Markets Head of U.S. Bank Equity Strategy. Welcome to both of you. Great to have you. Alicia, let's start with you. Do we have a rally going on in the S&P? They're up now, flirting with 4,200 again.
Look, I think the market is expecting that 4,200 ceiling to hold here. If the S&P manages to get through it, there's a little bit of blue sky out there, simply because that's where all the hedges are. So expectation that we're essentially fair valued here. Most of Wall Street says this is, we're fairly valued here. You can't get much higher. And as you know, when all the bears say the same thing and all the strategists say the same thing, the market tends to go in the other direction. So in part, the market rallied so hard this week on the expectation that the debt ceiling was going to be taken care of by this weekend, by Sunday.
Well, that's what I talk about, and not just this week, but this year so far. Isn't the S&P up something like 9%, something along those lines? So what is doing that? Is that because the earnings came in better than the expectations, which had been taken down, or is it because of the Fed?
So there's a couple of things going on. The first thing is there's actually a lot of liquidity in the system, because Janet Yellen at Treasury has been adding liquidity to the system to pay the U.S. bills, which is helping stock prices and specifically NASDAQ prices as well. That 9% increase in the S&P this year is essentially driven 85-90% by 7 stocks. It's not that other stocks aren't up, it's just that they're not heavily weighted enough to drive the index to this level. So you've got 7 stocks driving the index. They're all large cap tech. They're also associated with AI. So you've got overlapping stories here driving the index higher because it's concentrated in those really powerful names that drive the index.
Gerard, let's turn to you on the question of the banks, because that liquidity we're getting from the Fed to some extent is, if I can call it, the reversal of quantitative tightening because of what happened in the wake of Silicon Valley Bank and the other banks. Should we expect that to keep going, and are the banks going to keep drawing down on that liquidity?
I really, it's going to be interesting. It's a great question because the deposit flight is over. We know from what we saw in the middle of March when the Silicon Valley Signature and First Republic banks failed. Now, First Republic technically failed, obviously not in March, but at the end of April, early May. And I would say that the deposits that we saw today, they came out this afternoon with the H8 data. And what you saw with the H8 data was deposits are down slightly for the larger banks. Smaller banks generally flat to down. And so there's really no need to have to pull down liquidity, even though we still have, of course, discount window borrowings and the backstop borrowings with the bond portfolios from the Fed. So there's plenty of liquidity, as Alicia pointed out. And I think that the banks are certainly going to benefit from that as we go forward.
So, Alicia, if we don't have the problems with the depositors, it appears at the moment anymore, does that mean we're past the problems with the banks, or are there other things perhaps lurking out there?
So I think the immediate problem of the small and regional banks has been ring-fenced for the most part, and that's what you see actually in the equity market, because the bank sector is underperforming everything else, and every other sector is more or less all right because it's not as affected. So the ring-fencing and the policies that the FDIC and the Fed put together in March have been very helpful in that. I think ahead of us lies some consolidation in the small and medium-sized banks. Stock prices are essentially reflecting a valuation across the entire sector, which is more or less equal, even though there are very different members and operating businesses within that index. So not every bank is the same, not every small and regional is the same, so there's some opportunity there. The issue really is about whether the banking crisis is over, is how it affects the real economy and what it does to lending. And that is going to be a slow drift downwards, not right away. We've already seen lending start to contract 3 quarters ago, very slowly. It increased in the first quarter, the contraction. But the question is, where does that affect the real economy? Because as you know, the U.S. has held up pretty well. The data's been pretty good.
What about that, Gerard? How much credit tightening are we seeing? Do we have a real current read on how much credit tightening has gone on already?
David, the Senior Loan Officer Survey came out a couple of weeks ago, and certainly the banks have been tightening their underwriting standards for many months now. But more importantly, what it showed was the demand for commercial loans and commercial real estate loans was down quite a bit. So the banks are always willing to lend. They're in the business to make loans, of course. However, in more uncertain times, they take a more conservative underwriting approach. In a case of a commercial real estate loan, they're going to ask more of a down payment from the owner of the property, and that may make it prohibitive for the owner to buy that property. So you could argue, yes, they are tightening. We agree with that. The loan growth in the second half of 2022 was extraordinary. It was almost 10% for the industry. It's definitely slowed down. Typically, it grows at the nominal rate of growth, and that would be, right now, nominal real GDP growth. If the Atlanta Fed number is correct, you may have seen this week the real GDP number forecast came in at 2.9% with 5% inflation, 4% inflation, whatever number you like to choose. You're looking at nominal growth of 6+% right now.
Gerard, let's get specific right now for a moment about Morgan Stanley, because we did get that big news. Surprised a lot of people. James Gorman decided to step down, I think, after 13 years or so. What did he do? What is the legacy he leaves behind? And will his successor continue that legacy or maybe head off in a different direction?
It's a really good question because James Gorman has done a very good job. When you think about when he took over about 13 years ago, Morgan Stanley was in a very different place. And through the acquisitions of the old Smith Barney wealth management business, as well as the acquisitions more recently of E-Trade and Eaton Vance, he has diversified the revenues of Morgan Stanley, where wealth management now is about 45% of total revenues. Investment management is also a bigger presence today. And the investment banking and trading businesses are much smaller contributors than they were back in 08 and 09, which means it's a less volatile source of revenues and earnings going forward. So when he hands the reins over within the next 12 months, his successor is going to obviously continue balancing out the revenue stream because it has worked very well. The stock valuation for Morgan Stanley is much greater than his peer Goldman Sachs. And under his tenure, the last 13 years, his stock has outperformed just about all the financial bank stocks with the exception of JP Morgan.
Alicia, we've gotten through this entire wonderful conversation without talking about what the Fed's going to do. So how much of that is supporting what we're seeing right now in the stock market right now, the anticipation that the Fed will back off a little bit on the tightening?
Look, I think that's part of the reason that equities have been so buoyant, the expectation not just that the Fed is going to pause in June, but we're going to get rate cuts by the end of the year. Virtually everybody you speak to says, well, the Fed's not going to cut by the end of the year. So it's very curious to see who's pricing in the cuts in the second half of the year. But, to the extent that inflation stays sticky, and we've talked about this, that the goods sector is clearly in a disinflationary downturn. You've seen it in large cap box stores when they're talking about lower revenue. It's because the goods are coming lower in prices. But it's the service sector, core services, core inflation, core is at 5.5, core services at 6.8% inflation. The Fed's job is not done. And the interesting question is all this signaling that, June is not going to be a go. What if June becomes live? And then you get a repricing both in equities and bonds.
Well, it's fascinating. And what do you anticipate in June?
So I think the Fed's going to try very hard to signal that it's open, likely not to go. But if you get a bad inflation read and a very strong non-farm labor report, the Fed could go.
Terrific. Thank you so much, Alicia Levine of BNY Mellon and Gerard Cassidy of RBC Capital Markets. Coming up, we turn from big money center banks like Morgan Stanley to our regional banks and what went wrong and where we go from here with Professor Kathryn Judge of Columbia Law. That's coming up next on Wall Street Week, and we are on Bloomberg. This is Wall Street Week. I'm David Weston. The failure of three major regional banks may be in the rearview mirror, but the questions and the effects linger, as Torsten Slok of Apollo points out this week with one of his charts. This one on what it has meant for the borrowing costs of all regional banks.
What's noteworthy is what has happened to bank funding costs since Silicon Valley Bank collapsed. Most importantly, when you look at the bank IG index for OAS credit spreads, which you can split into regional banks and into diversified banks, meaning large money center banks, it shows you that funding costs further out, meaning 5 to 10 years, have increased about 200 basis points for regional banks, whereas they have only increased about 50 basis points for diversified banks. It does signal that the market is still asking some questions about what will happen in the longer run. But the fact that funding costs further out are still permanently higher is raising some questions about how long time will it take before this banking crisis that we're going through is going to be over.
And to take us through what has happened to regional banks in the wake of those three failures, we welcome now Professor Kathryn Judge. She's professor at the Columbia Law School, where she's also vice dean. So, Professor, thank you so much for being with us. We understand we have these three major regional bank failures. We're looking sort of in the rearview mirror to learn what went wrong and what can we do to avoid it next time. So what's your take basically on what went wrong?
A number of things went wrong. First, we made meaningful changes in the regulatory scheme governing large regional banks. With the benefit of hindsight, that was clearly in error. We've had three large regional banks fail, all in ways that impose significant hits to the deposit insurance fund. So clearly the deregulation was a problem. The banks themselves were a problem. It looks like they were taking a lot of risks without understanding those risks, without appropriately hedging those risks and managing those risks. And there were also shortcomings in supervision. It does look like some of this should have been identifiable, some of it was identified, but supervisors didn't act quickly enough and aggressive enough in escalating the concerns in ways that actually would have resolved the situations before we had such messy failures.
We've heard a lot about interest rate risk, which is a terrible thing to have, obviously, we've just seen. At the same time, given what the Fed was doing, it shouldn't have come as a surprise to the banks or to the supervisors that there's interest rate risk. I mean, we were raising interest rates like at an unprecedented pace.
We were, and the Fed really did signal that. And again, there was a long period of low for long and a period where rates were going up more slowly. But first of all, interest rate risk is a classic bank risk. I mean, in my very basic banking classes, I go back to the SNL debacle and I show how a changing interest rate environment affects the value of all assets that banks hold. So this is what banks are in the business of doing. And as you just pointed out, the Fed really did signal this. They said, look, we're really worried about inflation. There are concerns about inflation, and we're going to tighten as long as we need to really get that inflation under control. So both the amount of interest rate risk, the lack of hedging around that risk looks like a really inappropriate way of managing those risks.
The reason we look at these things is not just to say, I told you so, as much fun as that might be. We saw some of that maybe in Congress on Capitol Hill this week, actually with some bank leadership. But to say, what should we or could we be doing differently for the future? What did we learn, and did we learn it specifically about regional banks as opposed to the very big banks, or for that matter, the community banks?
A little bit of all of the above. So the biggest lessons have to do with regional banks. That we saw 3 large regional banks fail. 2 of them fail in a way that required regulators to invoke this systemic risk exception, suggests that that is where there's the biggest gap between what the regulatory scheme ought to look like and what the rules actually look like. But we also saw the failure of Credit Suisse on the other side of the Atlantic. We saw a rush merger with UBS that raises concerns about resolution planning. And there was already some meaningful work underway for Basel III implementation, which basically just means even the largest banks are going to face some tougher capital and liquidity requirements, and that's probably appropriate.
Is there also a potential flaw in the business model? And that is to say, you're taking deposits that by definition people can have whenever they want. So you're getting funding that is very, very short term, and you are necessarily putting it in longer term investments, such as 30-year mortgages, but also, as we learn, treasuries. Does that inherently put a lot of banks at risk?
Yes and no. So, I mean, the business of banking is to engage in maturity transformation. So there is a fragility that exists. On the other hand, it's been pretty well managed for a very long time. But then we have these periods of significant disruption. One of the things that's really striking right now is you look at the small community banks, and they've actually been remarkably stable. Even before the March turmoil, we saw depositors were leaving regional banks. They were leaving the largest banks because they just wanted to get a higher rate of interest than they were getting on their deposits. But the small community banks were really holding on to those deposits, and they managed to continue to provide meaningful credit. So it's not the entire bank business model. I do think we're seeing very real questions about the regional bank business model.
So what is, I'll use the term social contract, we should have with the regional banks? Because on the one hand, we want them to really support the real economy, as you put it. On the other hand, if they get in trouble, they turn to the federal government and say, bail us out. What should the essential social contract be with the regional banks? This is what we want you to do. We want you to lend money. We want you to help with credit. At the same time, these are the situations under which we'll actually help you out.
I was going to say, I think the social contract is part of what we're discussing on the Hill this week, last week, for the last couple of months, and in ways that have been really positive, right? I think one of the silver linings, if we can call it that, is revisiting this core question, not just with respect to regional banks, but banks generally. We are reminded of the fact that the government very frequently steps in to protect against losses. And here they allowed shareholders to lose money, they allowed non-depositor creditors to lose money. But there were a lot of uninsured depositors that ultimately were protected. And so if you're going to provide that type of support, then you want to ask ex ante, what are we really getting out of that?
What about the non-banks? You mentioned those before. They certainly have expanded dramatically, certainly since the great financial crisis. Why can't we just turn a lot of it over to them? What's the risk in that? What's the downside?
So there's a number of risks. So one is they are part of the ecosystem. They're going to remain part of the ecosystem. So trying to say, should it be banks, should it be non-banks, is a false dichotomy. At this point, it's both, and they're also integrated in very meaningful ways. But there are a lot of downsides. I mean, at this point, banks are subject to very meaningful regulation and oversight. Ideally, that promotes their safety and soundness and the resilience of the system. But it also provides policymakers a lot more insight into how well the financial system is serving the needs of the real economy.
We talked about deposits and what you called maturity transformation. Some people at this point are saying a mismatch between short-term and long-term there. Some people are saying we should just federally guarantee all deposits without limit. What do you make of that proposal?
I mean, I think we need to rethink the structure of the deposit scheme. It doesn't make a lot of sense that I have access to deposit insurance at the same level of a mid-sized business that needs far more just to make payroll. That being said, at this point, we insure a lot more than just what we think about as deposits. It's not just your checking account. It's also a CD. And we've moved away from the days where we used to have interest rate caps on those deposits. There's a lot of reasons to think that we should rethink the structure of how we go about deposit insurance. FDIC has a great new report on how to rethink it. But just removing the caps without doing a lot of the other work that we would potentially need to do could also involve a lot of money flowing to a lot of very troubled institutions.
Professor, thank you so much for being on Wall Street Week. That's Professor Kathryn Judge of the Columbia Law School. Coming up, China tries to get its economy back on track after the COVID shutdown. Deborah Lair of Edelman Global Advisory takes us through what's become of the Chinese economic miracle. This is Wall Street Week on Bloomberg. Global Wall Street lost a leading light this week when Sam Zell passed away at the age of 81. He went from managing student apartments in his dorm room at the University of Michigan to being a legendary investor in real estate and energy, making billions of dollars along the way. Zell was known first and foremost for his real estate investing, acquiring office space over many years in his Equity Office Properties Trust, and then selling it all to Blackstone in 2007 for $39 billion at just the right time.
We made a deal, and that deal was significantly higher than the NAV. And consequently, it was an easy decision for me, even though it was my baby. It was something I started from scratch.
Though in later years, valuations made Zell think twice before becoming a real estate buyer again.
For all practical purposes, I haven't bought anything in 10 years. And where the opportunity has created, I've sold it a lot.
Zell invested in energy of all sorts.
I've always believed that diversification is your friend. And I've always attempted to have some kind of energy diversification and continue to do so.
And recognize that the world needs to move away from fossil fuels while warning that it is going to take time.
We have got to reduce our energy exposure. The transition from fossil fuels to renewables is going to be a very long process.
Zell was called the grave dancer, taken from an article he wrote about resurrecting dead properties. But he always warned about the risks involved.
And, and as you're dancing around the graves, you have to be really careful you don't fall in.
Which he very nearly did in his leveraged buyout of the Tribune Company, for which he was roundly criticized and on which he lost $300 million. Sam Zell was deeply concerned about the fiscal health of the United States, alarmed about the growing debt, and concerned for what it could mean for the country's economic health.
We've added, $7 trillion to our debt in 3 years. This is the Weimar Republic. And if the United States isn't careful, they're going to find themselves in the Weimar Republic.
His memoir was titled, Am I Being Too Subtle? The Adventures of a Business Maverick. Whatever Sam Zell was, he was never subtle. He was a true original, as an investor and as a person, always preferring to follow his own, sometimes idiosyncratic, instincts.
I was very, very successful at listening to my own song. I was very capable of ignoring the noise. The number of times people have told me you don't understand is legendary. And yet I was comfortable and had the level of self-confidence that allowed me to make the right decisions at the right time.
China and the United States. What was an afterthought when President Nixon went to China in 1972 has now been catapulted to be the most important economic relationship in the world, as the Chinese economy has grown more than sixfold, trailing behind only the United States. And the U.S. helped it get there, leading the move to admit China into the WTO.
Bringing China into the WTO is a win-win decision.
And there's no doubt that U.S. trade with China has grown dramatically since the end of 2001, when China officially joined the WTO. But now the Chinese economic juggernaut is showing signs of slowing, as the COVID lockdown creates uncertainty about what comes next, and demographics weigh on growth. Not to mention continued tensions with the United States, which the WTO's Okonjo Iweala warns could damage global growth.
The costs of the world fragmenting into two trading blocks, very high. We've actually done some simulations of this at the WTO, and we've seen that if we break into two trading blocks, the world global GDP is going to decrease by 5% in the longer term.
And J.P. Morgan's Jamie Dimon insists we can avoid.
America and China have a lot of common interests: climate, nuclear proliferation, anti-terrorism, global stability, and we have differences. We're capitalists, they're not, and it's okay. We could sort that out, but we need to keep the Western alliances together, not just around war and Ukraine, but around strategic, economic relationships, including trade.
And to get an accurate and up-to-date picture of where China is right now, we welcome now a true expert in the area. She is Deborah Lair. She is both the vice chair of the Paulson Institute as well as the CEO of Edelman Global Advisory. Deborah, thank you for coming back to Wall Street. We really appreciate it. We now have the G7 meetings that are happening this week. China is not physically there, but certainly they are an important part of the audience. What is the message that the United States and other members of the G7 want China to take away from these meetings this week?
David, you're so right. They may not be present physically, but certainly China is one of the main topics. And it appears that the administration is going to work with its allies to try and get a united and very strong statement about being tough on China, both from a national security perspective, but also to coordinate economically.
As President Xi takes a look at his economy right now, does he have any doubts, do you think, at all about its growth pattern? Because it was a true economic miracle in the history of the world. I don't think we've seen anything like it. At the same time, we're getting some numbers, including this week we've gotten some numbers out of China, indicating that that growth is really slowing down. And some people are even saying maybe China will not, after all, pass the United States in the size of its economy.
It's been clear for a long time that Xi Jinping has been worried about the economy. And one of the reasons behind the whole corruption campaign that he started when he first came into office is because they couldn't govern and they were concerned about the state of the economy. And even until today, he's still sending out policy enforcement teams to ensure that mayors and governors are actually implementing the policies that he has dictated from Beijing. They have a lot of reason to be concerned about the economy. As we've seen in reports just recently, youth unemployment is at an all-time high at about 20%. Even though they've dealt with a lot of the systemic risk coming out of the real estate market, for the small and medium-sized real estate companies, a number of them are going to go bankrupt. This has an impact then on the banking system, and while they're not concerned about the large banks, they do believe that a number of the mid-sized banks who are operating in the provinces are facing very difficult challenges.
If, as you say, President Xi is concerned about his economy, does the West, and I mean to include both the United States and Europe and Japan, does it represent a potential help to him, or is it a part of the problem for him?
I think this is going to depend on Xi Jinping himself. And if he decides that he wants to be engaged with the West, then he needs to take the kind of steps to provide market access for companies, to provide more consistency. Regulatory risk is one of the biggest challenges that we see today because we're not quite sure what policies are going to come from the new Xi administration. By the same token, he's very concerned about the export markets. Right now, exports are really what's driving the Chinese economy, and we see weakness in those markets, and certainly as there's concerns about a recession ahead and weakness in some of their export markets, combined with the politics of trade with the United States and trade with the European Union, I think that's a real concern that they have to have. And so part of it is how do they create the confidence at home to unlock consumer demand? And they haven't been able to do that yet. They haven't been able to get consumers out spending their money in any significant way. And at the same token, how do they build relations either with the United States to keep those markets open, or can they find new markets? And part of what we're seeing with this more active foreign policy by Xi Jinping and his new team is how they build relations to compensate for some of the challenges that they're seeing in their trade with the United States.
Do you read very much into the increased pattern, apparently, of meetings with U.S. representatives? We had Jake Sullivan meeting in Vienna with his counterpart. We had Nick Burns, the U.S. ambassador, going in to meet with the foreign minister. Do you read anything into that? Because there's talk maybe Tony Blinken, the Secretary of State, would go over, maybe Janet Yellen?
Mm-hmm. Well, I hope that this is a recognition that there's concern about the free fall of the bilateral relationship. And both sides seem concerned about that. We run the risk of being slightly isolated. As we talked about in the G7 context, certainly the Biden administration would like to ensure that our allies are moving in lockstep with us on China, but we haven't been seeing that necessarily.
One of the stories that's gotten a lot of attention in the United States press, at least, is sort of the curtailment of operations of some of the consulting organizations over in China, the cutting off of data. Is there a risk that we're going to know even less than we did before about what's really going on in the country?
I think there's a large concern about data in many different ways. One is China definitely has been limiting access by foreigners to data, whether it's economic data, whether it's data that they're concerned about on national security purposes. We saw the whole issue when Didi listed overseas and they were forced to delist then from the United States. That was an issue over national security concerns about the kind of data that Didi would be sharing. The other thing, obviously, one part of that is the access that American or foreign consulting firms get to data. But another part of it is also what the Chinese are planning to do with data. They look at data as a factor of supply. They're creating a new regulator that's going to be in the National Development and Reform Commission. And for them, it's almost as a commodity. How can they get access to large amounts of data that they can collect internally as the government? They're developing new regulations to control the flow of data, whether it's cross-border, access by foreign firms, or even internally who gets access to what kind of data. And then they are potentially even looking to commercialize that data.
Deborah, finally, what about capital markets? Because there is a proposed, as I understand, executive order at the White House to limit U.S. investment in China, particularly in technology areas. How big a threat would that be perceived to be by President Xi?
Well, initially, I think it's very clear that the some kind of outbound investment restrictions are going to be put in place by the administration. And the big question is how broad they're going to be and whether they're voluntary initially or if you have to have pre-approval. And so it's going to be a big test, and it's going to be much bigger than just capital markets. It's going to actually impact anyone who's looking to invest, even companies who might be looking to make acquisitions or invest in different sectors in China. Initially, the administration is saying it's going to be limited to just a few categories, but subsequent administrations can broaden that. It's going to set an interesting precedent, and it, of course, is of concern to the Chinese. In part, they've been able to benefit, certainly, from capital flowing into China. These days, there's actually a lot of capital in China, and one of the interesting statistics that we've seen recently is China has almost 1,000 billionaires. There's a lot of money in China, and more money from other countries, particularly from the Middle East, is now flowing into China. So it's yet to be seen what the impact is going to be of these outbound investment, but hopefully when the administration does put it in place, it's not putting it in place in a way that disadvantages American companies.
Deborah, thank you so much. It's always such a treat to have you with Wall Street Week. That's Deborah Lair of the Paulson Institute, as well as Edelman Global Advisory. Coming up, what the fight over the debt ceiling is really costing us and what good may still come out of it. We'll talk with former chair of the Council of Economic Advisors, Glenn Hubbard of Columbia. That's next on Wall Street Week on Bloomberg.
I've had a love affair in the last year writing this book with Thomas Jefferson, who reminded us, I think, that he thought the Constitution should prevent us from passing debt on to our kids because, as he said, you'd swindle futurity and the earth would belong to the dead and not the living. I think at some point, Lou, what's going to happen is our kids are going to understand what $14 trillion of unfunded liabilities mean.
That, of course, was the late, great Pete Peterson talking about the growing crisis he saw in the federal debt back in October of 1993. And at that point, the debt totaled $4.5 trillion, which was then 48% of the nation's GDP. Today, it stands at $31.5 trillion and is a whopping 97% of GDP. To give us a broader perspective on the current crisis over the debt ceiling and what lies behind it, welcome Glenn Hubbard of the Columbia Business School, where he was dean after serving as chair of President George W. Bush's Council of Economic Advisors. Dr. Hubbard is the author, most recently, of The Wall and the Bridge, Fear and Opportunity in Disruption's Wake. So, Glenn, thank you so much for being back with us. Great to have you with us. So, we have a lot to talk about the default. Everybody agrees we can't have a default. It would be terrible. We don't spend quite as much time talking about what lies behind this crisis, which is addressing the debt problem. There is a real debt problem, is there not?
Well, there is. I mean, Pete was right. And I think the way to think about the debt ceiling crisis is to break it into two pieces. What do we have to do right now? And that's going to be some near-term spending restraint, like returning unspent COVID funds, some of the spending caps, for example, that Senator Manchin has talked about. But longer term, we've got to go to a different model. And we have to have either a spending limitation, as I've argued in the past, or some kind of model, for example, like the Swedes do, of a fiscal policy commission that takes a look at the budget. But we need that longer term discussion, dare I say, maybe even another commission to take a look at it, but it has to be separate from the short term, which we have to do first.
But I wonder, we'll come back, if we could, to possible solutions to the immediate crisis with the default, or would-be default. But are the Republicans, some of the Republicans are right, we'll never get to the second part if we don't hold hostage on the first. That's basically, as I understand it, a lot of Republicans' position. If we go along with you on the debt ceiling, we'll never do the second part, which is so important.
Well, that's right. But when you catch the car, you have to know what to do. And you also have to have a plan. And since neither side has what I would call a reasonable long-term fiscal plan at the moment, the right thing to do would be to take a deep breath. The problem is the same problem, actually, when Pete talked in 1993. It has to do with runaway social spending. This is at a time where we need to spend more on defense. We need to spend more on preparing Americans for the future. So we're going to have to make some fiscal adjustments. Some of those may be tax increases, some may be spending adjustments, but we have to pivot to that world.
So let's talk about getting past the immediate crisis for the moment. You know Washington well. Put aside for a moment what you think is the right answer. Let's talk about what is the doable answer, because that's terribly important. There are some red lines here, such as, for example, the Republicans say we cannot increase revenue. Full stop, can't do it. Is that right? Does the White House have to give on that point? We're not going to do anything in terms of raising revenue?
Well, I think in a negotiation, you have to let the other side tell you a bit about what it takes to have victory. And I think if Republicans have said there's no revenue increases in the near term, I wouldn't put that in a negotiation. I think a near term is the spending restraint. So something like returning the unspent COVID funds and a 2-year spending cap even. There's something that can be done so Republicans have a victory. Biden, I think, knows independent voters also agree with Republicans on many of these points, and he could come to the middle on that. That's where I think the solution has to be.
What about the work requirement? Because I suspect a lot of Americans do look at that and say it's not too outrageous to say you should have to try to work if you're really getting a lot of funds.
It's definitely not too outrageous. And if you look at polls, independents in the middle, about 2/3 support the work requirements. The only risk in a negotiation is when you start adding things that aren't central to the discussion, i.e. taxes, spending, you make it difficult to get to resolution. So each side has to look the other in the eye and say, well, what does he or she need to win, or at least think they've won, and move on.
So this week we saw the hopes go up, we saw the hopes go down. I mean, we heard they were making real progress, and then on Friday they stormed out of the meeting, which is not unheard of in Washington. You, Glenn Hubbard, knowing Washington the way you do, knowing the situation the way you do, how worried are you about an actual default?
I'm not terribly worried. That said, the probability isn't zero. And so the two sides have to be significantly working harder to come together. In the past, I always knew this was theater. It would simply work out, and we just have to endure it. This time, there's a little bit more uncertainty. So I do think pressure needs to be brought to bear on both sides to come to a near-term agreement and then pivot, as you say, to the longer-term discussion that we've really got to have as a nation.
So let's turn to that. Let's make that pivot, actually, to the longer-term discussion. Assume we get past the default issue. Now we're going to address it. You suggested, for example, a commission might be one way of doing it. We've done that with Social Security. We've done that with base closings. Is there political will on the two sides, at least enough political will, to actually do something about this instead of just talk about it?
There has to be. The math will catch up. We're already in fiscal year 2023 for the government. We'll have interest payments exceeding the money that we spend on children. That's crazy. We need to be spending more on defense. We need to be righting a number of ships in the country. We have to take a look at the composition of spending and revenue. A commission gives both sides a chance to have that discussion, and I think it's absolutely essential.
I want to come back to your book, The Wall and the Bridge, for a moment, because one of the issues is how can we grow the pie? By investing, spending the money, however much it is, in a way that grows the pie. Is there an appetite for that? Because Republicans certainly say it's all got to be about growth.
Well, but you also have the social support and the political support for growth. If we had programs that supported work, that prepared more Americans for the future that they will have, as opposed to a nostalgia for the past, we could do that fairly modestly with new spending. We would need to pay for that by cutting other spending or raising taxes, but it's doable. In my book, I suggested programs that together cost less than President Biden's student loan forgiveness. We know how to do this. We know how to find the money. We need to do it for something useful.
Let me go back to the here and now and where we are with the economy right at the moment and what the Fed needs to do, where we're looking at the economy. Let's assume we get past the default for just a moment. We hear that, in fact, maybe the neutral rate will go back down. What do you think, where do you think we are right now with the economy, and what does the Fed need to do?
I don't think this is a time for the Fed to do what markets are suggesting is start cutting rates in the very near future. The Fed, at a minimum, would have to keep the funds rate where it is. I would argue if there's a change in the funds rate in the next several months, it's probably up, not down. Inflation is still very, very sticky. So despite what markets think, I think the Fed still has an awful lot of work to do.
There was a report on the Bloomberg, actually, that in fact, if we get past the default problem, there will be a tightening necessarily in liquidity because the Fed has been spending, the Treasury, has been spending down what's in the coffers. They're going to have to replenish that by issuing a lot of T-bills over the course of the summer. As a practical matter, that will soak a lot of liquidity out of the system. Will that tighten enough in itself? Some people say it's at least 25 basis points.
I don't think so. It's a modest effect, as you suggest. There are two ways in which those T-bills can be bought. One is through bank reserves, the other through money market funds. But I think it's a modest effect. The bigger concern, it strikes me, would be a credit crunch that's in the offing from the banking problems. If you're thinking about effective monetary tightening, there's probably another 100 basis points of effective federal funds rate increases in that credit crunch. That's the one to watch.
When will we have a sense of, in fact, whether we have that 100 basis points? Because I've heard that number before, but I'm not sure if we know yet whether we have it.
Well, that number is a blend between effects on small and mid-sized banks, where it would be much larger, and then, of course, the very large banks, where it would be very small. I think the Fed in the next several months will be watching that very closely, which is an argument for the kind of pause that Chair Powell has signaled.
So many of us are not particularly pleased with what we're seeing going on in this negotiation about default. The notion that we would even think about reneging on the full faith and credit is really embarrassing. What does it do to us globally? Does it affect the value of the U.S. currency as reserve currency? What is the rest of the world thinking right now? Will there be longer-term effects?
Well, I think they think we're crazy. And of course we are in this kind of process. But the point is we need a new spending process. We have had a series of budget resolutions and budget reforms over the years. I mentioned Sweden before. I think using something like the Swedish plan and the Swedish Fiscal Policy Council, it's hard to advise conservatives to look at Sweden as an example, but that I do. That, I think, is our roadmap.
Are there people in Washington talking about these things right now?
There are. But I think at the moment, the negotiation is so mired in each side thrashing the other, it's hard to get out.
What about think tanks? Are they helping?
I think so. I think they're trying to get information to both sides of the aisle on the costs of what is happening and on things that might be proposed in the medium or long run as opposed to the action we have to take before June 1st.
So you're concerned but hopeful?
Always.
Always. That's Glenn Hubbard, I should say. In a nutshell, that's Glenn Hubbard. Many thanks, Glenn Hubbard of Columbia Business School. Coming up, going south. Will taking from the rich and giving to the poor help out our big northern cities? Will it help them regain their luster? That's coming up next. And we are on Wall Street Week, and we are on Bloomberg. Finally, one more thought. A tale of three cities. It was the best of times and the worst of times. At their best, cities like San Francisco, Chicago, and New York led global Wall Street, with Northern California dominating a tech sector that helped bring the markets back from the great financial crisis.
Today, the opportunities are in entrepreneurship, in Silicon Valley.
Chicago has provided the longtime home for commodities and future exchanges, as well as major financial players like Citadel. And of course, the granddaddy of them all, New York City, from which global Wall Street gets its name.
And so, another sun rises over fabulous and mighty Manhattan.
But the pandemic has shown some of the worst that can happen even to the best of American cities, as crime became a major factor in the recent election for Chicago mayor.
My name is Brandon Johnson. I'm running for mayor of the city of Chicago to usher in a better, stronger, safer Chicago.
Homelessness undermined the quality of life in San Francisco, and New York struggled with workers fleeing its office towers, even as migrants seeking refuge threatened to overwhelm the city.
We got 4,200 people last week came to our city for shelter. I need everybody to wrap their heads around that for a moment.
Given the problems, it's no great surprise that parts of global Wall Street are looking for greener pastures, as New York's Wall Street looks to Miami and what's becoming known as Wall Street South.
Miami is probably the most dynamic city in the country today.
Parts of San Francisco and Silicon Valley take a hard look at places like Texas.
The reason to move here is to get the best of both worlds.
And Ken Griffin moves his Citadel to Miami.
It wasn't me who drove the decision to come to Florida. It was the 100 and some people that lived in that bubble who said, why would we trade the anarchy in Chicago for the tranquility in Florida?
And even the CME, originally named for the city, has sold its Chicago real estate, though its CEO, Terry Duffy, says that doesn't necessarily mean that it's leaving.
That doesn't mean we're leaving. We like Chicago. I think Chicago's been on its back foot before, and it can get back on its front foot, but it takes all of us to do so.
But things may not be nearly as bad as some people fear. After all, New York's a long way from where it was in the mid-'70s, when President Ford famously, if not literally, told it to drop dead. And famed New York restaurateur Danny Meyer of Union Square Hospitality Group says New York has already come a long way back, even if it now looks a bit different.
It's come back beautifully in a lot of ways, but it's different. I have never in my entire career seen our restaurants fill up with people earlier in the evening.
And this week, we got a powerful signal of just how vibrant the original Wall Street still is, as its elite gathered at the Javits Center on the west side of Manhattan for the 35th annual Robin Hood Gala Dinner and raised over $61 million for New York City charities.
Each of us, in our own measure, whether large or small, over 4 decades, did our part to demonstratively break the cycle of poverty.
That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.